Here's a number that should not be possible. The average American who earns $94,000 per year is in many demonstrable ways less financially stable than the average American who earns $47,000 per year. Not metaphorically, not emotionally, materially less stable, more likely to take on debt in a medical emergency, more likely to accept a worse job offer after a layoff, more likely to stay in a bad living situation because the upfront cost of leaving is simply unavailable, more likely to have their life meaningfully disrupted by an unexpected expense that, relative to their income, should be trivial. This is not a poverty story. This is a structural story, and it has nothing to do with intelligence, discipline, or the quality of the person involved. It has everything to do with a piece of advice that has been repeated so many times by so many otherwise credible sources that nearly everyone in America has quietly accepted it as fact. Build a 3 to 6 month emergency fund. That advice, as we will examine in some detail, is not wrong in the way that bad advice is wrong. It is wrong in a much more dangerous way. It is wrong in the way that a car with a cracked frame looks fine, passes a casual inspection, and then fails catastrophically under the specific load it was designed to handle. The standard emergency fund advice was designed for a labor market that no longer exists, calibrated against expenses that no longer reflect what Americans actually spend, and measured against a standard of protection that was always a floor, not a ceiling. The person earning $94,000 per year who has 4 months of savings is not safe. They are adequately papered. There is a difference. This video is about that difference, why it matters, how the math actually works, and what a genuinely protective emergency fund looks like in 2026. There are 4 specific problems with the standard advice. We will work through each one. Problem 1, the 3-month myth. The 3 to 6 month emergency fund rule was not discovered. It was not derived from data. It was not the output of some actuarial model that examined real American financial volatility and produced an optimal buffer. It was, to be direct about it, invented. And it was invented in a very specific economic context that has essentially no relevance to 2026. The origins of the rule trace back to post-World War II personal finance writing, a genre that was itself responding to Depression-era anxiety. The logic, such as it was, ran something like this. An emergency is defined primarily as job loss. Job loss in a healthy economy with low unemployment and abundant manufacturing employment tends to resolve within a few weeks. Therefore, a buffer of 3 to 6 months is more than adequate to carry a household through the disruption. Job found, fund replenished, crisis averted. That logic made some sense in 1955. It has aged badly. The Bureau of Labor Statistics tracks the average duration of unemployment in the United States. This is not a measure of how long people can hold a job. It is a measure of how long, once unemployed, it takes Americans to find new employment. The number changes with economic conditions. In the years following the 2008 financial crisis, it reached nearly 40 weeks. In the tight labor market of 2021 and 22, it compressed to around 19 weeks. As of early 2026, the average duration of unemployment in the United States is approximately 22 weeks. That is just over 5 months. 5 months, on average, to find any new job. Not a better job. Not a job that matches the previous salary. Any job. This single data point destroys the 3-month rule entirely. If you have a 3-month emergency fund and you lose your job today, you run out of money before the average person in your situation finds new employment. You are not building a buffer. You are building a slightly longer runway before precisely the outcome a buffer was supposed to prevent. You are negotiating a new salary from a position of desperation, which is exactly the negotiating position that results in lower initial offers, worse benefits, and fewer opportunities to hold out for the right role. You are making permanent career decisions under temporary financial pressure, which is among the more reliable ways to end up with a career you did not want. A 6-month fund performs better, but 6 months still places you below the average resolution time for job loss. The median is not the mean. Half of people find employment faster than average. Half find employment slower. If you are unlucky, or if you are in a specialized field with a longer search horizon, or if the sector you work in contracts simultaneously with your layoff, 6 months is also not enough. There's a second layer to this problem that the 3 to 6 month framing obscures entirely. The framing assumes that job loss is the primary emergency. It is not. The primary emergency for most American households is the intersection of multiple stressors arriving simultaneously. a layoff combined with a car that needs substantial repairs, a medical event combined with a gap in health insurance coverage, a housing disruption combined with a period of reduced income, a family obligation combined with irregular work availability. According to Bankrate's Emergency Savings Report, 57% of Americans would be unable to cover an unexpected $1,000 expense using only savings. Not $4,000, not a month of expenses. $1,000, more than half the country. And the standard advice continues to be 3 to 6 months, repeated earnestly by the same sources that cite this statistic 2 paragraphs later. The 3 to 6 month rule is not conservative advice that fails ambitious savers. It is inadequate advice that fails ordinary people in ordinary circumstances. Problem 2. The leakage system. Emergency funds do not fail primarily because of catastrophic emergencies. This is the assumption that almost everyone makes, and it is wrong in a way that matters enormously for how you think about building and maintaining a buffer. Emergency funds fail primarily from what we might call the leakage system, a slow, continuous bleed of dollars out of the emergency account toward expenses that feel urgent but are not, by any reasonable definition, emergencies. The car registration bill that arrives every October and somehow feels like a surprise, the annual insurance premium that comes due in a lump sum, the dental work that has been visibly necessary for 3 months and finally becomes unavoidable, the appliance that has been operating at reduced capacity for a year and finally stops, the flight that needs to be booked because a family situation has escalated. None of these are emergencies. They are irregular, predictable expenses. They are the kind of expenses that, if you had been accounting for them month by month, would not require any special fund at all. They would simply be covered by the portion of monthly cash flow that had been set aside for exactly this purpose. But most people do not account for them monthly. They construct a mental budget based on what they spend in an ordinary month, then encounter the extraordinary months where these irregular expenses cluster, find that their regular budget cannot absorb them, and transfer money from the emergency fund because the emergency fund is the only separate account that exists for exactly this purpose. The problem is that this behavior erodes the fund continuously, well before any genuine emergency arrives. And when the genuine emergency does arrive, the fund that was supposed to cover 12 to 18 months of stress is perhaps covering 2. The financial term for this is sinking fund depletion through category confusion. The practical term for it is a fund that does not protect you when you actually need it. The solution is not to have more discipline about the emergency fund. Discipline is the wrong tool. Discipline requires continuous active decisions. The solution is to build a second account entirely separate from the emergency fund, specifically for irregular, predictable expenses. This is sometimes called a sinking fund. The mechanism is simple. You identify every expense you know is coming in the next 12 months that does not arrive on a monthly basis. You total those expenses, you divide by 12. You transfer that amount every month into the sinking fund. When the irregular expense arrives, you pay it from the sinking fund, not the emergency fund. The emergency fund remains structurally intact because it never sees the irregular, predictable expenses. It only ever gets called upon for genuine emergencies, which are far rarer and less predictable by definition. The typical American household has, once they actually inventory these expenses carefully, somewhere between $2,200 and $2,000 per year in irregular, predictable expenses that they are currently misrouting to their emergency fund or, more commonly, to credit cards. Moving $150 to $170 per month into a sinking fund captures this entire category, removes it permanently from the emergency fund's risk surface, and eliminates a significant source of ongoing financial anxiety. The anxiety point matters more than it might initially seem. One of the primary reasons people abandon savings plans is that the plans fail visibly and repeatedly. When the emergency fund gets drained by a dental bill and then refilled slowly over several months and then drained again by the car registration, the plan appears to not be working. The person involved concludes, correctly from their observable experience, that saving is hard and the progress is not real. The sinking fund removes these failure events by giving irregular expenses their own home. The emergency fund then accumulates without interruption, which creates the visible momentum that makes a plan feel achievable rather than futile. Problem 3. The silent tax. The emergency fund advice has a second structural failure that the 3 to 6 month debate almost never surfaces. It concerns not how much money you should have, but where that money should live. Most Americans who follow the standard advice and build an emergency fund do so by accumulating money in a traditional savings account at their primary bank. The bank is familiar. The account is convenient. Transfers are instantaneous. The money is visible alongside the checking account in the same app, which creates a comforting sense of proximity. That proximity is also a problem, which we will address momentarily. But the more immediately measurable problem is the interest rate. As of early 2026, the national average interest rate on a traditional savings account in the United States is approximately 4.41% annual percentage yield. This is the rate that the large retail banks pay their savings account holders for the privilege of holding their money. 0.41%. On a $20,000 emergency fund, this generates approximately $82 per year. High-yield savings accounts at online banks are, at the same point in time, paying between 4.2 and 4.8% annual percentage yield. These accounts are federally insured by the FDIC up to $250,000, which means they carry exactly the same government guarantee as the savings account at your brick-and-mortar bank. They are equally liquid. Transfers to and from an external checking account typically clear within 1 to 2 business days. There's no minimum deposit requirement at most of these institutions. There's no fee structure. The money is simply held in an account that pays 10 to 12 times more interest than the traditional alternative. On a $20,000 emergency fund, the difference between 0.41% and 4.5% is the difference between $82 per year and $900 per year. That is $818 annually that traditional savings account holders are not receiving for no reason other than the account they chose to use. Over a 4-year accumulation period, the compounding effect of this difference adds up to a meaningful acceleration of the fund's growth. This is not a speculative or complex financial instrument. It is a savings account. It is holding the same money. It is offering the same legal protections. It is simply paying more because the banks offering these rates are online-only institutions with lower operational overhead, and they pass that overhead reduction to depositors. Institutions worth examining in this category as of 2026 include Marcus by Goldman Sachs, Ally Bank, and SoFi. These are established institutions. FDIC insurance applies to each of them. The transfer process to a primary checking account at another bank takes a few minutes of configuration once. There is a secondary benefit to this account structure that connects directly to the leakage problem. Money held at a separate institution from your checking account has friction, not meaningful friction, not friction that prevents you from accessing it in a real emergency, but enough friction that it does not become a casual transfer target for expenses that feel urgent but are not genuine emergencies. The checking account tap is not present in the same app. A transfer has to be initiated deliberately. This deliberate step introduces a moment of evaluation between the impulse and the action. In practice, this small friction prevents a significant portion of the leakage events that erode emergency funds over time. The traditional advice to build a 3 to 6 month emergency fund does not specify where to hold it. This omission costs the people who follow the advice, conservatively, several $100s per year for the entire duration of their financial life. That is the silent tax. Problem 4, the Cascade Effect. The final failure of the standard emergency fund advice is the most difficult to quantify, which may be why it receives the least attention. It concerns not what happens when the emergency fund is fully funded, but what happens when it is not. An underfunded emergency fund does not simply fail to protect you from financial stress. It actively amplifies the severity of the financial stress it encounters. It creates conditions under which a single disruptive event triggers a cascade of secondary consequences, each of which costs additional money, additional time, and additional opportunity. The buffer is not neutral when it fails. Its failure is multiplicative. Consider the mechanics of a layoff for someone with 2 months of savings. In the first 2 months, they search for a job. The search is not desperate yet, but they are aware of the timeline. They are watching the balance. At the end of month 2, the emergency fund is exhausted. They have not found suitable new employment. They now have a series of decisions to make under financial pressure, and each of those decisions has a cost. They might accept the first reasonable offer they receive, even if the compensation is substantially below their previous role, because the alternative is not paying rent. Accepting a lower salary does not just affect the next paycheck. It affects the baseline from which future raises are calculated. It affects the negotiating position for the next role. It affects the career trajectory. A permanent reduction in lifetime earnings can trace its origin to a single month where the emergency fund ran out and the only available option was suboptimal. They might carry existing expenses on credit during the gap. At a typical credit card interest rate of between 22 and 26% annually, every 1,000 of gap spending generates between 220 and 260 of interest per year until it is resolved. The emergency that costs $3,000 in direct expenses becomes a $4,000 event over 18 months of repayment. They might miss a payment during the disruption. A single late payment on a mortgage, a car loan, or a credit card can lower a credit score by 40 to 100 points, depending on the prior score and the history. A lower credit score raises the interest rate on future borrowing. This effect persists for 7 years on the credit report. They might defer necessary maintenance on a car because the cash is not available. Deferred maintenance on a vehicle compounds. A brake service that costs $300 becomes a rotor replacement that costs $900 becomes a caliper failure that costs $400. The emergency fund that was not there to cover the $300 service ultimately generates a $400 cost. None of these cascade effects are counted in the standard emergency fund analysis. The standard analysis says a 3-month fund is sufficient to handle a 3-month disruption. It does not account for the fact that a 3-month disruption plus an exhausted fund generates additional costs that extend the disruption, raise the total bill, and impair future financial decisions in ways that compound over years. A 12-month fund does not just give you more time. It gives you a fundamentally different negotiating position in every decision you make during a disruption. You are not making decisions from desperation. You are not forced to accept the first available option. You are not carrying credit card debt on top of reduced income. You are not deferring maintenance you cannot afford. You are operating from a position of actual stability rather than the performed stability of someone who has 4 months of savings and is hoping that 4 months is enough. There is also a cost to carrying financial anxiety that resists clean measurement but is nonetheless real. The American Psychological Association's annual Stress in America report has, for more than 15 years, consistently identified money as the leading source of stress for American adults. Chronic financial stress is associated with impaired working memory, reduced executive function, worse sleep, elevated cortisol, and measurably lower quality decision-making. These are not soft outcomes. They are functional impairments that affect every domain of life, including the professional domain, where the decisions that most affect financial outcomes get made. The person who knows they have 12 months of expenses in reserve makes different decisions in a job negotiation, in a vendor conversation, in a performance review, in a difficult workplace situation, than the person who knows they have 3 months and is very much aware that the clock is ticking. That difference in negotiating posture, compounded over a career, produces a meaningfully different financial outcome. The 12-month fund earns returns that never appear on any balance sheet. Building the 12-month fund. The objection at this point in the analysis is predictable. 12 months of expenses sounds like an aspirational target for people who already have money, not a practical plan for people who are paycheck to paycheck now. Let us look at the math directly, because the math is usually the source of the discouragement. The first step is determining what 12 months of your expenses actually costs. This is not your annual income. It is not even your annual spending. It is your annual necessary spending, defined as the expenses you cannot eliminate during a disruption. Rent or mortgage, utilities, groceries, transportation, health insurance, phone. These vary by household, but for a single person in a mid-cost U.S. city, the total of genuinely necessary monthly expenses often comes in between $1,600 and $2,200 per month. Call it $1,900 as a working number. 12 months of $1,200 is $22,800. That is the target, not your annual income times 12, not your current monthly spending times 12, your necessary monthly spending times 12. A household taking home $3,000 per month after taxes, after paying $799 in necessary expenses, has $100 remaining in monthly cash flow. The question is, how much of that $100 can be directed toward the emergency fund consistently? At $400 per month, which represents roughly 36% of that remaining cash flow, the timeline to $20,800 is 57 months at zero interest. That is almost 5 years, which is long enough to make the goal feel remote. The acceleration mechanisms are what compress the timeline. First, place the fund in a high-yield savings account from the first dollar. At 4.5% AP, The interest earned on accumulating balances reduces the required contributions over a 4-year period by approximately 200 to 1,600. This is money generated by the account itself, not by additional savings effort. It reduces the finish line. Second, build the sinking fund concurrently. Identify every irregular, predictable expense for the next 12 months. Total them. Divide by 12. Transfer that amount monthly into a separate account. The typical household finds between $100 and $175 per month in irregular expenses they were previously absorbing from the emergency fund or from credit cards. Routing these correctly prevents the fund from being repeatedly raided, which allows the accumulation to proceed without interruption. Third, automate the contribution at a frequency that matches the payroll cycle. Weekly or bi-weekly automated transfers smooth the psychological load of the contribution and remove it from the domain of active decision-making. Research from Vanguard has found consistently across datasets that automated savers accumulate meaningfully more than manual contributors at the same income and expense profile. The mechanism is not mathematical, it is behavioral. The decision to transfer money is made once at setup rather than repeatedly, which eliminates the recurring opportunity to defer or skip. Fourth, examine the recurring expense base for one meaningful reduction. A single renegotiated bill can add $50 to $100 per month to the emergency fund contribution without any lifestyle adjustment. Auto insurance, internet service, phone plans, and subscription bundles are the most tractable targets for most households. The savings go directly and automatically to the emergency fund. Fifth, redirect windfalls. Tax refunds, end-of-year bonuses, cash gifts, freelance payments, and asset sales that occur during the accumulation period should be directed to the emergency fund until the fund is complete. The average American tax refund in 2025 was approximately $3,138. One tax refund at this amount added to the accumulation reduces the timeline by 6 to 8 months at a $400 per month base contribution rate. The combination of these 5 mechanisms, applied simultaneously to a $400 per month base contribution, does not produce a 5-year timeline. It produces a timeline of approximately 28 to 36 months, depending on the household's specific numbers and windfall profile. 3 years to a 12-month emergency fund is achievable on an ordinary income. It is also, by most measures, an understated life improvement. According to the Federal Reserve's Survey of Consumer Finances, the households in the highest quartile of liquid savings report meaningfully higher rates of job change, negotiated salary increases, and career advancement than equivalent income households in the lowest quartile of liquid savings. The mechanism is not mysterious. The ability to leave a bad job, to hold out for a better offer, to take an upfront cost opportunity that will pay off over time is not available to people who are operating at the edge of their financial capacity. It is available to people with reserve. The emergency fund is not simply a hedge against disaster. It is the asset class that enables optionality. And optionality in a life context is worth considerably more than any comparable financial instrument. Let us return to where we started. The person earning $94,000 per year who has never addressed the structural inadequacy of the standard advice has, in many cases, a lifestyle that has expanded to accommodate the income. Their necessary monthly expenses might be $3,200. Their target emergency fund at 12 months would be $38,400. They have $9,000 in a traditional savings account paying 4.1%. They feel comfortable. They are not. The person earning $47,000 per year who addressed the math several years ago has $21,600 in a high-yield savings account paying 4.5%. Their monthly contribution is automated and has been running without interruption for 2 years. They have a sinking fund for irregular expenses that is also running on autopilot. They are protected in a way that the higher earner is not, and they are protected at an income level that most personal finance advice would describe as challenging. The gap between these two people is not income, it is not luck, it is not discipline in the conventional sense. It is the understanding that the standard advice was calibrated for a different era, that the target it specifies is a floor rather than a ceiling, that the account in which most people hold their buffer is working against them, and that the budget category from which most people draw emergency funds is doing most of the damage long before any genuine emergency arrives. The Empower research from early 2026 found that 62% of Americans have less than 3 months of expenses in liquid savings. That means in a country where the average job search takes 22 weeks, the majority of the workforce is a layoff away from a decision-making crisis. The majority. Not the poor, not the unlucky. The majority. The standard advice did not produce this outcome despite being correct. It produced this outcome in part because 3 months was accepted as sufficient, and sufficient is often the enemy of protective. 3 months feels like enough. Enough removes urgency. Removed urgency removes action. The fund that would have been built is the fund that was never started, because the standard advised 3 months and 3 months felt achievable someday, which is the standard distance from financial security for most American households. Someday is the operative problem, not ignorance, not irresponsibility. Someday. The 12-month target does not get set aside until someday. It gets built because it is the number that actually protects you, and protection is the point of the exercise. The systems that build it are not heroic. They are a high-yield account, a sinking fund, an automated transfer, one renegotiated bill, and a rule about windfalls. That is the entire mechanism. Nothing in that list requires a specific income. Nothing in that list requires a windfall. Nothing in that list requires a different job or a side hustle or a market that cooperates. The question is not whether you can afford to build it. The question is whether you can afford the decisions you will make when it is not there. That question has a clear answer. It is the same answer it has always been. Understanding money is your best defense.